Hello, my name is Joe Blondin, and I'm proud to be the president at Clark State College. Clark State is so honored to be the lead sponsor for the Pursuit of Excellence series at the Logan County Chamber. And I'm Tony Oberholzer. I am the Vice President for Advancement and Outreach at Clark State. We're here to support your workforce needs. Please contact us if there is anything that we can do to support you, including with funding support if necessary. Clark State has a lot of opportunities to get training paid to make your company even more excellent than it already is. So please be in touch, and thank you so much.
Hey everyone, Jacob from Ascend Consulting here. Wanted to talk about something that most small businesses face in their lifetime, which is small business financing, how to get cash in the door to help you finance operations. We're going to go from cash flow management all the way up to venture debt. Not going to take too long today, but want to run through some of these quickly and give you a quick primer so you can dive deeper on what these options are in the future. The first one that I always like to look at is say, are you optimizing your cash flow and are you using that in the most effective way? We always want to get paid before we have to pay. So the question always becomes, are you acting as a bank for your customers, or are your customers acting as the bank for you? If you are invoicing people and it's taking you 60 days to get paid and you have to pay your people before you get paid, then you're acting as a bank for your customer because you're doing the work, you're paying all your people, and then finally the customer pays you. So you had to front that cash for those 60 days. On the flip side of that, if the customer pays you up front, you do the work and you don't have to pay your people. You don't have to pay for your inventory for 60 days. Now the customer just acted as a bank for you and you got to use their cash for 60 days without any interest or anything. So as we look at this and we have a company come to us that's needing cash, the first place we look is what is that timing and how are they getting paid? So some things to look at here is encourage advance payments from your customers. Make sure you're invoicing very quickly on time with the job. Make sure you're managing your inventory effectively, and then negotiate your supplier terms. So, hey, can you extend out payment terms with your suppliers? How do you push that out to make sure your customer's acting as the bank for you? Or even if you have to act as the bank, we're limiting that amount of time that you have to act as the bank. This will increase your cash flow and increase the cash in your bank. So you don't always have to go to the bank and borrow money and pay somebody else to get that money. Let's optimize your cash flow first. So that is always the first place to start. The Small Business Administration is out there. It is a great tool to use as you start looking and wanting to get a loan. There are some really great benefits with this, lower down payments, lower interest rates, flexible fund usage. So you have a lot of flexibility in where you go to do this. And typically these are 10-year repayment terms. And some people want to say, hey, this isn't low interest rate, but for the terms it's typically low interest rate because, they're not requiring it to be fully collateralized. There are ways there that you don't have to have assets to back everything up. You don't have to have these things. Now, there's definitely some downsides to a small business loan that include a long application process. Most people say, to get an SBA loan, you're looking at 60 to 90 days to get that done. You have to have a business plan and financial statements have to be there and ready to go. You're also likely going to have to sign a personal guarantee and collateralize it with your personal assets, which some people are not willing to do, but definitely is a great source of funds. When a lot of traditional sources are not available, the SBA will be available to you. Collateralized loans. So these are probably the most common loan in small business. So these are your equipment loans, your building loan, where you are collateralizing it with an asset. So you have an asset that you are bringing to the table and is going to put up as collateral. These are great from the fact of lenders have less risk here because they know if you fail, they can go take your asset from you and they have security in that. As a result of this, those do typically have lower interest rates. Higher borrowing limits. So as long as you have collateral, many times they're willing to lend that money. And, this allows you to save money over the long term because of those interest rates. So there's some drawbacks here around, obviously you have to have a risk of asset seizures. And then the assets you are putting up for collateral have to be appraised to determine the correct value. So in real estate, many times you have to pay for an appraiser. Vehicle loans are pretty easy because, there's Kelley Blue Book, some of those services that they can just use to determine the value. But some assets that people want to pledge are very hard to value. And that means there's a complication there in getting that loan. Accounts receivable loans, we like to do lines of credit for our clients based upon AR. So banks will lend against your future invoices. So this is a great way where maybe we can't optimize our cash flow and get our customers to pay ahead of time. So instead, we will go to the bank and say, let's pledge our AR against the line of credit. So the bank has collateral on your accounts receivable, and as a result, they will lend you money. So a lot of banks will do 50% or 60% on your accounts receivable, but this means now you have that cash. So you now just optimize your cash flow by using the bank. The downside to this is higher interest rates, extensive documentation. You do have to pay interest on that money. So optimizing your cash flow is way better than pledging your accounts receivable to get lines of credit. But this does free that cash up right away to go out and leverage that cash to continue growing your business. Continuing on the accounts receivable side, this is one that is definitely an option. We don't like this near as much as the line of credit option, but this is, factoring your accounts receivable, which is essentially selling your accounts receivable to get immediate cash. And you're basically handing those accounts receivable off to somebody else to go collect, transfer the credit risk to them, because if it's uncollectible, they've already paid you for it. It's not yours at that point. But there are significant fees involved with this. So typically, they're going to only pay you 70, 80 cents on the dollar for them to take this on. So there is significant fees here, but there are a lot of people out there that will buy your accounts receivable, which gives you immediate cash, transfers that credit risk, and allows you to have that cash. There's also a huge downside here is now you have introduced somebody else into your client relationship. So if you have an ongoing relationship with that client, now there's this third party that they have to deal with to collect and to pay that is trying to collect from them, and they will have to pay. So definitely from a customer service perspective, this can introduce some challenges and customer experience perspective. Development loans is another great piece here. If you're in Ohio, or most agencies, they have a developmental agency that gives development loans to help with these things. So these are great tools to use as you're having trouble on others. I know some places have collateral enhancement loans, which they will pledge collateral to help a bank lend to you and reduce the interest rate. So that's there. Minority-owned businesses have a lot of these where it's typically lower interest rates, flexible terms on repayment, support to make things happen. But in all of these, there's definitely additional oversight and reporting and to make those pieces happen. Venture debt. So this is definitely another option here. And lots of people hear about venture capital, which is typically giving up space on your capital table or giving up ownership in your company at a venture, which we often say venture capital is the most expensive form here. So giving up equity to a venture capitalist is the most expensive form of capital you can get because you give up all the future upsides of that percentage of the company. Venture debt is a subset of that where venture capitalists say, hey, we will actually lend to you instead of taking an equity position in your company. So venture debt, typically a lot higher interest rates in these because they don't have any collateral to them. They don't have any real way to collect from you if the company goes bankrupt, right? So some of these do include warrants for equity purchase. So they will lend you debt, and if you don't pay it back, they can convert it to equity. But these do allow you to extend that runway without the ownership dilution. Beneficial if you are doing equity rounds. It gives you kind of funding between those equity funding rounds, but also venture debt is typically a little more risky. So if you have a risky place and you're not in as strong a position, they may be willing to take that risk in exchange for that much higher interest rate. So this is definitely something you can look at. The last one here isn't so much a financing, typical financing option, but it is investors. In this, you're going to give up some of your ownership. So this is by far the most expensive form of capital here. If you do a lot of this, you have the potential to lose control. But at the same time, there's huge benefits to bringing on investors from the fact you can get funding when there is no other way to get funding many times, and to make that possible and bring that in. Also, when you bring investors on, they're much more willing to share your expertise. And if these investors have cash to invest with you, many times they have been successful elsewhere. So they're going to bring their expertise to the table, as well as some mentorship, kind of help you talk you through things as you face them in your business. And many times they have a lot of connections for you that can open a lot of other doors that can help your business grow in ways that otherwise wouldn't be possible. So bringing on investors can be really, really powerful, but just be aware, it is the most expensive form of capital because you now share in the upside of the company with them. As you think through what's the right funding option for you, that's a big decision to make. We wanted to run through a couple of these options today and say, hey, keep working at this. You are building something great, so keep moving forward from that perspective, but take time to make sure you're picking the right funding options for you. Hope that helps, and we'll talk to you in the future.